Hi guys. Today we will analyze Bristol-Myers Squibb stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, the stock is only an average performer. Both the short-term and long-term trends are positive. Strong support level is around $61.50. Next strong support level is around $56. Resistance level is around $68. The next resistance level is around $70. In the last month the stock has been trading between $61 and $67 range, which is quite wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 13 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 21% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 166% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Bristol-Myers Squibb Company: bad, average, and good. First scenario. The company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 14%. Future free cash flow to net income rate would be low, 40%. In this case, the fair value of the stock today would be $50. The second scenario. The company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 16%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $76. The third scenario. The company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 18%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $112. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.12. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Bristol-Myers Squibb, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for the company: bad, average, and good. First scenario. The company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $22. Second scenario. The company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future P/E would be average, 16. In this case, the fair value of the stock today would be $30. Third scenario. The company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 18. In this case, the fair value of the stock today would be $40. As you can see, today the stock is overvalued, $66, even if we expect the company's high performance in future. Both the profitability and the financial health of the company are neutral. Nothing too spectacular is happening here. The stock is not valued too expensively and it also shows a medium growth rate. I own the stock and I'll buy more if the stock drops below $55. Company's strengths. BMS is a leading worldwide biopharmaceutical company. Its products focus on oncology, immunology and cardiovascular conditions. Bristol's next largest drugs, immuno-oncology drug Opdivo and cardiovascular drug Eliquis, look poised for additional gains over the next 5 years. More than half of Bristol's late-stage pipeline focuses on immunology and cancer indications where the FDA aggressively approves drugs and which typically hold strong pricing power. Bristol has created a strong pipeline and brought in partners to share the development costs and diversify the risks of clinical and regulatory failure. Bristol holds a sound balance sheet. A strong balance sheet helps biopharma firms through most product litigation challenges with minimal concern by the market. Risks. The company faces risks in developing and commercializing new drugs. The development process, from discovery to regulatory approval, can take more than 10 years and consume hundreds of millions of dollars. Only a small percentage of drugs that enter clinical trials emerge with FDA or EC approval. The pharmaceutical industry faces pricing pressures as regulatory agencies may seek to lower the cost of drugs. Revlimid, the company's largest product by revenue, faces generic competition in the US and in overseas markets in 2022. The company will have difficulty replacing the lost Revlimid revenue. The stock is currently trading at a sharp valuation discount to peers, which reflects concerns about this competitive headwind. A large portion of Bristol's valuation is tied to cancer drug Opdivo, which could have an amplified negative impact on the stock if clinical data is poor or if competitors report superior data. The company is expected to show only a medium growth in revenue and in earnings per share. In the coming 5 years, the revenue will grow by 6 to 8% yearly, the EPS will grow by 5% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.